Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at a few mega cap stocks to consider buying before earnings and perhaps holding for the long haul. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast. And make sure to check out our new Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into these two large cap, mega cap Dow components, I want to just quickly go over the broader market to give a sense of where we are heading into we're in the middle of the busy part of the fourth quarter earnings season. And before we talk about these two stocks, so the S&P 500 was in correction territory and the Nasdaq was down around 15% from its records until the market started to bounce back in a big way Friday afternoon amid strength from Apple and a few others. And then we saw the buying continue through morning trading on Monday, with the Nasdaq up around 2.2% as of around midday, and the S&P 500 up roughly 1% as I'm looking at this right at the moment. So the bounce back is continuing, and the S&P 500 is now back above its 200-day moving average after falling below it for the first time since the initial COVID sell-off, while the Nasdaq is still farther off, climbing back above that 200-day level, but it is attempting a comeback. Clearly, there could be more selling, but it does appear that some buyers have stepped in, with the S&P 500 trading at forward earnings multiples that are much closer to its pre-pandemic levels. The downturn to start 2022 also had hit nearly every corner of the market, yet, as I just mentioned, the bulls appear to be attempting to make a stand since the sell-off has really recalibrated valuations throughout many strong stocks and indexes in general, and wiped away nearly 2 years worth of gains for not just super growth focused stocks that did well during the pandemic, but even established giants like Netflix. So there could be more volatility in selling, as I said, but Wall Street is laser focused on the Fed's rate timeline and increasingly worried about the size of future rate hikes. With all that said, the 10-year U.S. Treasury is currently sitting at 1.79%, which is roughly below its late 2019 levels, and within the same range, or within the range of between 1.5 and 3% that it's floated between over the last decade. And rates are also extremely low by historical standards. If we look back before the financial crisis, we're way below what the levels used to be. So obviously, higher rates do negatively impact companies, especially growth-focused firms, but interest rates in general will have to climb a lot higher before they start to make stocks broadly unappealing. And along with these relatively accommodating rates, the outlook for S&P 500 revenue, margins, and earnings are strong for 2022 and 2023. So overall, despite the worries and higher interest rates and still lingering COVID worries, this downturn has recalibrated things, and maybe some of the worst selling could be over. Obviously, you never know, but if you're a longer-term investor holding things for years and years and years, maybe even decades, you might want to consider buying strong stocks even amid the volatility, if you're going to be considering them holding for a very long time. So the first of these two mega cap stocks that are reporting in the next few weeks that we're going to look at to maybe consider buying is Disney, and that trades under the ticker DIS, for those of you who didn't know. And it's set to report its Q1 FY 2022 earnings on Wednesday, February 9th, so next Wednesday. And now we're just going to quickly dive into everything that's going on in general with Disney. So Disney fell way short of Q4 earnings estimates in November, and Wall Street dumped the stock on slowing streaming growth. So that recent post-earnings decline extended a longer downtrend that sets up a relatively solid entry point for the entertainment powerhouse, because despite what was a, quote, disappointing quarter based on expectations, the firm added roughly 2.1 million new Disney Plus subscribers, which should come in far below analyst estimates. The figure also marked its slowest growth since the launch in November of 2019. And that, quote, miss, though, is a tad misleading. So Disney Plus boasts 118 million subscribers at the moment, and executives reiterated on their call the 230 to 260 million subscriber guidance by the end of 2024, or its FY 2024, for its namesake streaming platform. The new goal blows away its initial 60 to 90 million projection that it released back in the fall of 2019 when it first launched Disney Plus. So it's already blown away those initial expectations. And overall, the streaming space hits 179 million. So this is all of its streaming platforms. So this is Disney Plus, ESPN Plus, and Hulu. For reference, Netflix has around 220 million at the moment, right around there, or it's expected to reach there by the end of the current first quarter. The company is now also one of the major players in a growth industry, that streaming industry, and its catalog and brands remain at the top of the food chain and really desirable for families and individuals. So this is Star Wars, Pixar, Marvel, Disney itself, other brands. And we should also note that its Star Wars and Marvel movies were dominating theaters before the pandemic. And obviously COVID temporarily crushed its park segment, but the entertainment's Titans parks and resorts, from Disney World in Orlando to other resorts around the world, are back open. On top of that, it's began releasing movies again in theaters, and they've done relatively well, especially given the circumstances. And as things return closer to normal, once again, and throughout many parts of the U.S. already, you can see more and more people rushing back into the theaters as they just try to return to their pre-pandemic lives. So with that in mind, Disney's revenue climbed 26% last quarter and 3% on the year. And Zacks estimates now call for its 2022 revenue to soar 25%, to crush its pre-COVID totals by 16 billion at roughly 84 billion, with 2023 set to climb another 12% higher to reach 94 billion. At the bottom end of the income statement, its adjusted earnings are expected to skyrocket 82% this year and then another 37% next year. And it is worth noting that it's FY 2022, so the current estimate for its bottom line for the full year is down from where it was before the past quarter. That's based on slowing growth and some other COVID headwinds that have seen things not race back to those pre-pandemic levels that people were expecting. But its FY 2023 figure has been down a little bit less significantly, but both of those are down from where they were before its previous release. And we should also note that the company has crushed our bottom line estimates in 3 out of the last 4 quarters, with the notable miss being last quarter when it missed by about 27% on the bottom line. But before that, it beat by 40%, 172%, and 171%. So massive beats in the 3 quarters before last. Disney also lands its Zacks number 3 hold at the moment, and Wall Street is still really rather bullish on the stock, with 11 of the 19 brokerage recommendations that Zacks has at strong buys, with 3 more buys and then nothing sitting below a hold. We should also note that the stock popped. It was last up around 2% the last time I looked on Monday, trading around $141 per share. This still gives the stock 30% more upside before it runs into our current Zacks consensus price target, so plenty of room to run there. The stock has also climbed out of oversold RSI territory, which is 30 or under. That was at last week. It had been hammered with much of the market, and this is some of the reason technical focused traders have started to buy back in. It was sitting at 21 in terms of RSI, and it's already back up to 39, which is still below median levels at 50. Shares are also still down 9% in 2022 and are now flat over the past 2 years. So you can essentially buy Disney stock where it was before the pandemic. As we mentioned, Netflix and many of these stocks have seen all of their pandemic gains washed away. So if you're a longer term investor and you were considering Disney at any time in the last 2 years or before the pandemic, you could essentially scoop it up to where it was at those levels. So pretty attractive there. The decline also completely recalibrated its valuation, which had grown really out of whack amid the huge pandemic climb when its parks and theaters units were crushed. So the stock's now trading at 29.6 times forward 12-month earnings, which is not too far off of the roughly 25.4 it was trading at in December of 2019. But in the last year and a half, it had traded as high as 76 times forward earnings, and this is when everything was shut down, but everyone just dove back into the stock because streaming was doing so well. So it's now sitting much closer to its median over the last 3 years, which obviously has been a little out of whack because of all that pandemic buying, but it's trading at around 29.6 times forward 12-month earnings, which is much better than where it was before. So investors with longer term horizons might want to consider scooping up Disney stock now, even if it falls a little bit further, and maybe you might not want to buy it right around earnings, but definitely worth considering to put it on your radar since it's not bounced back and it's still sitting well below its current consensus estimates and where it was just in the past year alone, just since it's lost so much of its, as we said, it's lost all of its COVID gains. And now we're going to move on to another stock that's actually done well recently, and that is Coca-Cola, which is in a ticker KO. So its Q4 results are due out on Thursday, February 10th. So next Thursday. The pandemic, like with Disney, affected a large portion of Coca-Cola's business, especially in the early going amid lockdowns, and there was nobody going to movie theaters or sporting events, and that was that out-of-home market is where Coca-Cola gets a lot of its business. Luckily, though, executives said this past March that volumes returned to those pre-COVID levels, and things have been really looking up since then. So despite all those setbacks, the pandemic actually pushed Coca-Cola to ramp up its restructuring efforts, which includes reducing its workforce, cutting underperforming brands, and much more. So the beverage powerhouse has also spent the last several years revamping its business to adapt to changing consumer habits. These efforts include the purchase of a potential Starbucks rival, Costa Coffee, investments in Gatorade Challenger Body Armor, which it then took full control of in this past November, so a few months ago. And the company's even launched an alcoholic version of its Topo Chico sparkling water to get in on that booming hard seltzer market to compete against Boston Beer and many of the other hard seltzer players. Perhaps most importantly, though, the away-from-home venues such as restaurants, movie theaters, and stadiums have mounted impressive comebacks despite some of the recent COVID setbacks. So Zacks estimates are calling for its fiscal 2021 revenue to jump 15.5%, so 16% to $38 billion, with FY 2022 set to come another 7% higher at $40.7 billion. These projections would see KO climb above its pre-pandemic levels this year of 37, so essentially do $1 billion more in sales this year than it did in 2019. And then its adjusted earnings are expected to climb by 17% this year and then another 6% next year. KO, like Disneyland's Zacks ranking with the hold at the moment, though it's topped our adjusted earnings estimates by an average of 14% in the trailing 4 quarters. And 7 of the 12 brokerage recommendations that Zacks has are strong buys, with also nothing lower than a hold, which is a good sign. And then in terms of its dividend payout is pretty solid at the moment. Its yield is 2.8%, which comes in above its rival PepsiCo, which is at 2.5% and well above the 30-year U.S. Treasury at 2.1% and well above the 10-year U.S. Treasury. So you're getting a nice solid dividend yield from Coca-Cola at the moment. And this is coming despite the fact that the stock's up 25% in the last year and 3% in 2022 versus the S&P 500's decline of 7%. With it now trading above its pre-pandemic levels. And it sits at roughly at the moment at $60.70, which is still below its Zacks consensus price target. We should also note that it's trading at around 25.1 times forward 12-month earnings, which is not too far above its median over the last 3 years and well below its highs over the last year as well. So valuation is looking relatively solid for Coca-Cola. So if you're a longer-term investor, even with these constantly changing consumer habits, Coca-Cola has been able to prove and diversify its portfolio and shed businesses that aren't working, add ones that are working for the future. And KO still remains one of the world's most valuable brands, according to Forbes, coming even in ahead of the company we just talked about, Disney and McDonald's and Nike, and behind really only the tech behemoths like Apple and some others. So if you're a longer term investor and you want to consider adding a nice dividend paying stock to your portfolio that's been able to succeed while others have failed in the last several months amid the broader downturn, and especially so far in 2022, it might be worth considering Coca-Cola heading into its upcoming earnings release. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.